Good morning, this is Steve Dalton from AgVantage Commodities with another commodity market update. Grain markets were higher overnight and it was great to see another green screen across the grains complex. For soybeans, continued solid export of soybeans saw November 20 up 9 3/4 US cents a bushel. Current estimates are that approximately 72% of the 2021 soybean crop has been sold. So that's a pretty huge number. And that's the highest since 1990. Keep in mind that this strong demand is happening at the same time as the US soybean harvest is approximately 80% complete. So where you'd expect some harvest pressure, we're actually seeing stronger prices, stronger demand. Soybeans and canola obviously being correlated due to the oil component. We also saw ICE and European canola values up. Moving on to corn, whilst recent export sales have been lighter over the last couple of weeks for corn, and certainly when you compare that to soybeans, the market seemed to deflect this news and push the CBOT December 20 contract up 3.5 US cents a bushel to 408 3/4. And we would estimate that current US corn harvest is 50% complete. And now the big one for Australian growers is wheat. It was another strong performance in US wheat futures overnight, which is obviously great to see, reaching a 6-year high, with Chicago December 20 moving up 5 cents to 632 US cents a bushel. From a technical point of view, the target looks like it's around that 650. So we got the 632, technical targets around that 650, and you'd expect that's now within firm view of the market. So let's see if we can keep pushing. The wheat supply story is building momentum, and that's really on the back of the continued dry conditions in Europe, the US, South America, and Western Australia on a more local level. When we look at Russia and the Black Sea area, large competitors or suppliers of wheat globally, in Russia, this year remains the driest in the past 40 years. And the closest dry year, back in 1994, saw an average reduction of 12%, or approximately 12%. So current estimates could be as much as 15% is unlikely to be planted if the dryness continues. The market's becoming increasingly spooked about the ominous weather forecasts here in Australia, and obviously most people on the East Coast would be well aware of that. And that's resulted in some grade spread movements. We've seen the lower grades move from SFW, or actually Fed 1, move from less 50 out to as much as less 90. That's not to say everyone's on less 90, but spreads are moving. And we're seeing a slight increase in the upper grades. So look, as of yesterday, we've still been achieving less 50 for FED1 and less 35 for SFW1. So if weather does continue to if weather does downgrade the crop, we'll obviously see lower grade spreads widen initially, with the higher grades increasing in value. So we recommend anyone with harvesting high grade wheat is to store it and hang on to it, because that's going to increase significantly if we do get a major downgrading event. Barley continues to be the poor cousin of wheat, and if we were to see a major weather downgrade of barley and wheat quality, this would certainly pressure the domestic feed market just through the increase in supply of feed quality grains. However, it's important to keep in mind and keep in perspective that global prices for feed grains has increased since mid-August this year, and Australia will be able to export feed grains. In northern New South Wales, we tend to get an AH9. Most of you would be familiar with that, and that's really a higher protein, low falling number, shot and sprung style wheat, and that does have value, and it's got value both domestically and in the export market. Domestically for more of a gluten sort of commercial basis, such as Manildra, but also Vietnam is generally a strong market for AH9, and they can actually use it as a milling grade. So the key point is not to panic. If this happens, In the scenario of a weather-damaged harvest, experience shows that our markets always, and I repeat always, sell off the low grades at harvest as people panic. Things then settle down into the new year and those low grades increase in value. So main point, don't panic. Durum, whilst bread wheat and durum are not 100% correlated, the strong global fundamentals driving grain prices are influencing durum values. Whilst we haven't seen durum values increase as much, that's really just due to the wide spread between bread wheat and durum as it stands already. So we recommend a similar strategy for durum as for bread wheat, that is harvest, work out your quality, then look at marketing. I really don't think the solution is grabbing a $90 discount for feed, because feed won't be at a $90 discount come 2021. It might be at harvest as the pressure gains, but I can assure you it won't stay there. Faba beans, locally the faba bean quality has been low, and with the majority of deliveries falling into the number 2 and number 3 grades due to largely the virus that we've been seeing. There are still some beans to be harvested, so the market will be very keen to see if quality improves. And as per our previous reports, we recommend growers look to harvest, assess their quality, then call us to discuss your best options. We are looking at some domestic markets and believe we'll have some of those secured once we know the quality. And so we need some export, we'll need some domestic homes as export demand is poor at the moment, and we'll expect that northern New South Wales export premium to disappear as harvest moves south. But notwithstanding the fact that we're likely to see some price spikes and opportunities due to washouts as a result of the quality concerns I've just mentioned. Canola markets have been supported by dry conditions in Europe, along with the global grain fundamentals. We've had many calls from growers recently in the last few days with oil around that 35 to 38. And obviously this quality is not suited for delivery into the crusher market, where you'll be exposed to oil discounts. Just so you know, the discounts for oil are calculated as 1.5% per 1% below 42, which is the base. So if you're down around 35% oil, it's close to 10% discount. An admix is calculated on a 1% per 1% over 3. And if you were to get to 4 or greater, then it's calculated on 2% per 1% above 4% of admix. So 3% your maximum, and then it's 1% up to 4, and then it's 2% per 1% over 4. And obviously this can result in significant discounts. So give us a call. We do have flat priced homes. You will need a minimum oil of say 35. We do have minimum 38s. You'll need a minimum test weight of 62 and maximum admix of 3. So call us if you would fall into that category. Chickpeas, the chickpea market has been driven higher over the last couple of months due to the market really wanting early new crop, and also rumours out of India that the government may look at removing or if not decreasing the import tariffs. Central Queensland growers have been first cab off the rank, so they've been able to take advantage of that price rise. But just since last week, we have seen a sell-off of approximately $50 a tonne, as we are looking at a reasonable sized crop. I still don't believe we're going to have 750,000 tonnes. I think we're closer to 500,000 tonnes, but we need to actually find who's right or who's wrong. And also those rumours have not eventuated, or at least not yet, if they're going to at all. So please give us a call on 02 6792 2962 if we can give you any assistance or you'd like to discuss some options. Until we speak, all the best for harvest.